What's up, everyone? Just going to get everything situated and started, get the sound checked, and then we'll get the conference call going. All right. One more sound check, and then we'll get the show on the road. All right. What's up, everybody? Art Turner, Data Productions Media. Dreams are tangible aspirations where we scheme our dreams to existence. I have a banger conference call for you today. Conference call number 16, Data Capital Invest, Sunday, June 30th, 2024. I have a good one for you today. It's simple in a lot of aspects and what we're going to be talking about, but it's powerful in how you analyze specific companies and specific industries. So I'm really excited to share this today. As usual, remember for the gematria, the theme of this year, Data Productions Media, Capital Investments, monthly YouTube live stream, stock presentations, 333 English reduction. Remember, it's very powerful. Stocks presentation, 333 English reduction. So right here. All right. As always, disclaimer, I am not a financial advisor. All investing and trading risks you take are on your own. These conference calls are for education purposes only and entertainment purposes as well. Any information discussed to be used is at the discretion of the individual, not Data Productions Media, Capital Investments. Data Productions Media, Capital Investments has zero liability in any outcomes from anyone using information discussed in the conference calls. All right, and so for the meeting 16 outline, this is what we'll be going over today. We're going to be going over return on assets, ROA, return on equity, ROE. So some formula work for fundamental analysis. Then we're going to get into the tanking, shipping, crude oil industry. We're going to talk about how that industry is of a lot of importance, even as the world is trying to get quote unquote more green. We're going to get into the oil tanker super cycle with prices of not only the crude oil, but actually the carrier oil tankers. And we're going to get into the dividend that I recently added to the data divvy pack portfolio earlier this month. Nordic American Tankers, NAT, and it's a crude oil tanker company out of Bermuda. Really good dividend. Really excited about it. And then we'll get into the top 2 performers, data dividend portfolio, the bottom 2 performers, some honorable mentions, and we'll get some questions and answers at the end. So that's the meeting outline today. It's going to be super simple, pretty quick, but very still intense information. All right, and so we're not trying to waste anybody's time on these. We're trying to get in, learn, get out. All right. Return on assets, ROA, return on equity, ROE. These are very important, especially when we're talking about the tanking industry we're talking about today. So return on assets, ROA, is a financial ratio that indicates how profitable a company is in relation to its total assets. It is commonly expressed as a percentage using a company's net income and average assets. So you see return on assets formula, net income divided by average total assets. A company's ROA can also indicate how well it's managing its assets to generate profits. Average ROAs can vary significantly by industry. For example, an asset-intensive company like an airline might have an ROA of 2%, while a company with fewer assets and a similar net income might have an ROA of 15. In general terms, ROA above 5% is generally considered good. An ROA above 20%, a return on assets above 20% is considered excellent. Again, it varies industry to industry, and you have to compare the other businesses within that industry to get a good gauge. But those are for the general consensus. For some gematria, we have return on assets, ROA, is a good metric, 137, English reduction, the 33rd prime. We have ROA and ROE for asset and capital heavy stocks equals 133 in English reduction. And so now getting into return on equity, ROE is the measure of a company's net income divided by its shareholders' equity. ROE is a gauge of a corporation's profitability and how efficiently it generates those profits. The higher the ROE, the better a company is at converting its equity financing into profits. A return on equity, ROE ratio of 15 to 20% is generally considered good. It's higher than the ROA, while 5% is considered low. Ideal ROE can vary by industry, with some industries considering an ROE of over 25% desirable, while others may consider over 15 exceptional. The single biggest difference between ROA and ROE is that the ROE takes into account a company's debt, while ROA doesn't. If a company doesn't have any debt, these two numbers would be the same for that company. Remember, shareholder equity equals total assets divided by total liabilities. All right. Well, I mean, it would be negative. It'd be minus. All right, it'd be negative. It'd be minus. So not divided by, but minus assets minus uh, liabilities equals the shareholder equity. So not divided. And then we got return on equity formula, ROE, net income, annual, and then the shareholder equity, which is assets minus the liabilities. Then we have, for gematria, we have return on equity, ROE, has use, 333, English ordinal, powerful, and the 117 of English reduction together. So return on equity, ROE, is an important metric for companies. Okay, they look at it. Equity is your capital, your assets, your liabilities, everything. What are you getting out of that profitability wise? And are you doing it? Are you generating net profits efficiently? So when you look at ROA and ROE, especially in asset heavy companies, capital intensive companies, industries, these are good signs, and make sure to compare them to different companies within that industry to get a gauge on where that stock you're looking at, what it's doing. Okay. And so that's what I have on ROA and ROE. So now let's get into our industry outlook for the shipping and tanking industry. All right, this is very fascinating. When I started to look into this, I kind of got obsessed because the crude oil industry is so important. Oil, even after all this time and fear that people like to put in people's eyes with the electric vehicles, green movement, ESG, people really forget to realize that oil is still a big part of a lot what we do. Heating, transportation, any type of energy, power generation, anything, it's still important. So it's not going anywhere. And so a crude oil tanker is an oil tanker built specifically for transporting crude oil as opposed to refined oil. Crude oil tankers are built in a limited number of sites around the world, primarily in Asia, such as China, Japan, and South Korea. Some well-known publicly listed crude tanker companies include Frontline Limited, FRO, which, even though we're not talking about them today, I actually kind of like the CEO. I actually kind of like their fundamentals and stuff. Not better than what we're going over today, but Frontline would be another crude oil tanker that I would look into. TK Tankers Limited, TNK. Sacco's Energy Navigation, TNP. Nordic American Tankers, NAT, which we're going to be talking about today, started a position. Then we have DHT Holdings, DHT, and then Euronav, EURN. Again, this is a capital intensive business. And so let's look at some of the tankers in this industry. So there's a couple sizes. They have the coastal tanker, the smaller version, the Aframax. This is the smallest that most will talk about online and stuff. And most oil tanker companies within this realm, they'll have Afromaxes as the smallest. Suezmax, that's literally the workhorse for the whole industry. For the most part, most companies have more Suezmaxes than anything else. Some companies like NAT, Nordic American Tanker, they only have Suezmaxes. It can do long range travel, and it's small enough to get through the Suez Canal. So it's very versatile. Then you have the VLCCs, the very large crude oil tankers. Now these carry a bunch of oil. Now these are usually for really open waters, open ocean transportation. So we're talking about Japan to California, just huge travel. They're not really trying to go through any canals or anything. And so those are the heavy hitters. And then we have the ULCCs, the ultra large crude oil tankers. Again, open ocean, open seas. And within this industry, it's at a crux right now. It's at a pivotal moment. Oil's going through it, but also you have demand issues for crude oil tankers in the next couple years. So now that puts the industry and companies in a kind of a positive situation where if you have workable a workable fleet that you don't have to renew anytime soon, you just have to reap the rewards of the higher oil transportation costs and whatnot. And so there's an excerpt I saw from an article. In terms of new build crude tanker prices, the standard VLCC is now estimated at 160 million, a Suezmax at 78 million, and an Aframax at 60.5 million. This compares to 92 million, 63 million, and 51 million respectively in January 2021. Showing the considerable increase in prices over the last 16 months. So you see the crude oil tanker prices to get them built have only skyrocketed. And if you do research in the industry, it takes 2 to 3 years to build these things. So that's a lot of capital invested on something that you can't get for quite some time. You might be missing out on a lot of the revenues that's happening within the oil tanker industry right now. So that's where it's at. And in April 2024, the International Energy Agency, the IEA, predicted that global oil demand would grow by 1.2 million barrels per day in 2024 and 1.1 million barrels per day in 2025. However, in May 2024, the IEA lowered its forecast to 1.1 million barrels per day, citing weak demand in developed countries, poor industrial activity, and a mild winter. The IEA also noted that this level of growth is still in line with pre-COVID trends, even with increased clean energy technologies and muted economic growth expectations. So even with that downgrade of just a little bit, the IEA still sees like, look, before COVID even happened, if we take COVID off the table real quick, oil consumption, consumption has still been in line of what it's been doing. And so it really hasn't been hindered. The show is just going on. And the people that are smart enough and are willing to invest in that the ideology that's playing out is going to be very profitable. And so from this article, Sea Trade Maritime, 5-year-old Suezmax tankers worth more than new builds. So, this article came out in May 29, 2024. The Baltics analysts estimate a new build cost for Suezmax is 77.3 million, right? And compared to the 5-year-old vessel worth 82.8 million. Meaning, in most cases, especially like for cars, as soon as you take a car off the lot, it loses its value. It depreciates. But we're in an interesting predicament with the tanking industry because everybody in the industry knows there's profits to be had now. Like the rates, the TCE rates right now, the time charter equivalent rates for transportation of oil, they're going to be staying up at elevated levels. There's money to be made. The demand's not going down. COVID only put like a little bit of a bump in that. And so that's why 5-year-old Suezmaxes are more expensive, because if you buy one now, you can make profit now, and you might be able to offset that investment later. And so that's where the industry is at right now. And shippers are turning to longer-term leases as tanker supplies tighten. So as the tanker supplies tighten, people are, might just want a little bit more of that security. So they might be getting into longer contracts with like bigger firms like Chevron, ExxonMobil, BP, where they just have a flat rate, a flat TCE rate where, is good on both sides, but they don't have to worry about any fluctuations in the next couple years, because this is a very interesting time right now in the markets in regards to crude oil. There is an interesting there's an interesting thing I kind of figured out about the shipping industry. Now, what I didn't realize, and then we'll be talking about this on the next slide as well. Norway is known for oil and is Europe's second largest producer of oil and gas after Russia. The petroleum sector is a key driver of Norway's economy, accounting for 24% of its GDP, 19% of its investments, 36% of state revenues, and 52% of exports. In 2022, Norway had the largest oil revenues in Western Europe, with 7.7 barrels a billion barrels of crude oil. Now we'll get into on the next slide, but Norway is a key powerhouse. They had an oil boom, what I looked up, and I believe in the 70s, where they just found a whole lot of oil, and that elevated that Scandinavian country like no other. They had a huge oil industry, and they produced a lot of crude oil tanking corporate talent in the way of CEOs and stuff. And you'll notice a lot of CEOs of these crude oil tanking companies, they're Norwegian. All right. And that's not by accident. It's Norway is an undercover oil powerhouse. You know, it's only a couple notches down below the U.S. and Saudi Arabia and Russia. Last time I checked, it's definitely the top 10, and I believe it's in the top 5. So that's where the shipping, tanking, oil industry is currently. And to top onto that, we have to talk about the oil tanker super cycle, which is happening within the industry. And so time charter rates for oil tankers are the daily rates, usually in US dollars, that oil companies or traders pay to hire a vessel for a specific period of time or for specific trips. The vessel's owner supplies the crew and the vessel, but the charterer chooses the route, ports, and speed of the ship. Time charter rates range in the $40,000 per day range right now, which you can see you know, on the charts. Well, this is from 2005 to 2017. For many years, that those are elevated levels. So you look at 2005 to 2017. Look, you know, either it was high or it was low. It was hardly ever in the middle. All right, but now everything's in that $40,000 range right now for time charter. Crude oil tanker earnings in 2023 were firm compared to historical levels. The global tanker fleet achieved average earnings of $40,766 per day in 2022 and $40,775 per day in 2023. Stayed firm, according to Clarkson Research Services, CRS, which noted continued support from longer haul trades following the redistribution of Russian oil flows post the Ukraine invasion. And you got, so we have VLCC earnings increased by 80% year on year to $43,206 per day in 2023 on the back of rebounding Chinese crude imports and increased Atlantic exports, which earnings in the Suezmax and Aframax sectors remained very robust, exceeding VLCC earnings for a third consecutive year. Jefferies' equity research team noted in its 2024 outlook paper that it continues to view the medium-term outlook favorably for tankers, with generally healthy oil demand growth, increased oil production, and record low new vessel capacity, pointing to another strong year that both the crude and product segments are in line to perform strongly, with projected fleet utilization to increase to 90% from 89% in 2023, compared to just 84% in 2022. So Jefferies Equity Research, a big equity research firm, is saying 2024 is firmly going to be a good year for tankers, and 2025 should generally be the same, especially when we're looking at medium-term outlook. So for myself, medium-term outlook, for me, I would say that's like 1 to 3 years around. And so if we're staying up higher for longer, I know that's like an interest rate term, but if TC crude rate prices are staying up higher for longer, that just benefits everyone in the industry. All high tides raises all boats. Okay, and going back to the historical chart, you'll see. I don't think we'll get up to those levels with the VLCCs $90,000 per day. But, you know, having this range right here at 40,000, that's pretty hefty. That is pretty hefty. We get a couple years out of that. And if you pick a good company to invest in, they're going to be making a lot of money. You know, it's going to be super cash flows that they're not necessarily used to on a large scale. All right. So that's going to be good. Crude oil tanker super cycle in 2024, 333 English ordinal, super easy. Crude oil tankers super cycle in 2024, 333 English ordinal. So we're in the super cycle. Shoot, has the super cycle even really started yet? We're at the beginning still, in my opinion. And reading and listening to a lot of other CEOs, they feel the same way. The longer this draws out, the longer and higher this will go for prices. Crude oil tankers that were suppressed during COVID era will have a super cycle after 333 English reduction. So very powerful what's happening in the crude oil industry. The super cycle is on, and if you're invested, you should be pretty happy about that. All right, so let's get into our dividend play. Just added this to the portfolio early in June, and I'm actually super excited. I actually did add shares in late May, but I'm super excited about this. It's at a great price, and I'm excited to share with you guys because I think we can make some money for the dividend portfolio, and this should actually supercharge the income, right? The supercharge just the whole the assets under management for the portfolio. So we have Nordic American Tankers, NAT. The industry is crude oil shipping. Headquarters, Hamilton, Bermuda, which is interesting. And this is why I like this company for one. Even though it's technically international company, Bermuda might be under U.S. Rule. There's no fee. There's no ADR fee. Like if you wanted to invest in a Japanese, English, Australian company, there's an ADR fee, and so they take that out of they take that out of your dividends, capital gains tax, and whatnot. Not for this. No ADR fee for this. So it's not going to hurt our compounding effect at all. The dividend yield at around $4 is about 10.75%, 75%. So 10, 11% dividend yield, it's high. You know, a lot of people say, oh, you don't want high dividends because they're taking cash away from the business to grow. Well, for the crude oil tanker industry, there's not much growth on the bone to be had per se operationally. It's highly competitive. People already have large long-term contracts. A lot of things are set in stone. The growth comes from the pricing. All right. And so that's why the super cycle is important. The growth comes from the super cycle with their income and profits getting more generated and whatnot. We're not investing in this company to see a super high stock price. Yeah, we want to see the stock price go up. I would like to see the stock price go from $4 to $6, but we want to make sure that dividend's intact. All right. The PE ratio really in line. You know, it's 8x PE ratio. The CEO, Herbjorn Hansen, Norwegian, and you'll see right here my little small bag of NAT right now. I have 49 shares at average of $4.04. It's sitting at $3.98 right now. So really anything under 4, I'm pretty confident in buying. So I'm going to be getting into the mix again. I'm going to keep adding more shares on. In regards to what's happening on the insider board of directors level, so on March 12th, 2024, only 4 months ago, Alexander Hassan, non-executive vice chairman of Nordic American Tankers and son of Herbjorn Hansen, the NAT founder, chairman, CEO, bought 250,000 shares of NAT at $4.25 per share for a total sum of $1 million. And so when I first initially bought shares, when I first initially bought shares of NAT, it was around that 425 per share range. Obviously, I just wanted to get in the game, okay? But when it started to go under 4, that's when I really started to buy more. And so I'm gonna just keep doing that process. It's one of the only opportunities in the market right now that I really like, and I'm gonna keep levering into it. In regards to some gematria, I have NAT stock, 100% Suez tanker fleet, 330 English ordinal, 30 0 is just a value placeholder. Shipping and Pluto and Aquarius, 133 English reduction. Pluto, the planet Pluto is in Aquarius right now, so we're in a more Aquarian, a water-based age, oil tanking, shipping industry, right in line. Oil tanker stocks with war conflict, obviously, we've always been in war conflict, 133 English reduction. Nordic American tanker stock in 2024, 133 reduction. So as you see, all these equal 133 in reduction. Shipping in Pluto and Aquarius, oil tanker stocks with war conflict, Nordic American tanker stock in 2024. Then we have a bunch of 137s, the 33rd prime in English reduction. We have Nordic American tankers profit, shipping stock, Pluto and Aquarius. Norwegians run crude oil tankers. Nordic American Tankers Limited, NAT in 2024. And Nordic American Tankers Limited, NA stock 2024, all equaling 137 English reduction, the 33rd prime. So you see the power there. And this is why I like the company. The son of the CEO and founder just bought $1 million of their company 3 months ago. Does that not show confidence to you? I think that's a lot of confidence. And they know where this is heading. Okay? They know where this is heading. So if the son's buying, I'm buying. Not financial advice, though. And so moving forward for Nordic American Tankers, NAT, before I go over the highlights that Herbjorn talked about, I'll go over some of the number highlights that fundamentally, okay. So the assets they have is 869 million, 0.72 million. Total liabilities is 340, almost 341 million. So their net shareholder equity is 528.3 million. And so don't disregard the B. It's million. So 528 million. Shares outstanding 208 million. So the net equity fair value, just off shareholder equity to the shares outstanding, the net equity share value is $2.53. Now that's if the company was sold tomorrow with their assets and liabilities. That doesn't account for the super cycle we're in right now. That does not account for the time charter rates that are, at firm, stable levels, at elevated levels right now. And that's why you see the premiums on the stock. That's why we have about $1.50 premium on the stock right now. It's because of the part of the cycle these companies are in. So it's not a bad thing. I don't think it gets down to 250, but if it did, I'd be buying a lot. The 2023 revenue was 391 million. The 2023 operating expenses was 74 million. 2023 net income was 98.7 million. And so with the new annual dividend, now this is what they really did this year. Annual dividend is 48 cents for the whole year, so 12 cents per quarter, times the outstanding shares outstanding. It's going to be 100.2 million per year that they have to pay out in dividends. Okay, so their net income is almost in line with their dividend. And a lot of cases, in this case, companies will use leverage. They will use loans to pay the dividend, so it doesn't hurt operations on the back end. And I think that's sometimes a smart move. The return on assets is 11.45%. So that's in line with the industry average within the shipping industry. You want to see it above 10 return on assets for the crude tanker industry. Return on equity, 18.7 at 17%. Now, this is above average in most cases for most companies, but this is low for the tanker industry. There's return on equities up to like 38%, 40% in some companies. And, you know, somebody might ask me, Art, why this company? We went earlier on in this conference call talking about we want higher equity, return on equity, the better. Why are you picking Nordic American Tankers that has an 18 ROE over, like, you know, Frontline or somebody else that has 30%? Well, the difference is the return on equity for NAT would be a lot better if they didn't have a dividend. Over time, dividends, you know, kind of they chip away at the ROE. They degrade it a little bit because, you know, you're taking away, you're using profits, net income to pay the dividend, which takes away from your assets, which could be cash on hand, right? And so it slowly just, you know, chips away at the ROE. But the big difference is NAT has a dividend that is double, in a lot of cases triple, of what these other shipping crude oil tanker companies are doing. All right, and so that's fine. They have the Nordic NAT has a 10% dividend with a still good return on equity at 18%. That's okay if another tanker has a 30% ROE but only a 3% dividend. It all kind of evens out. I'm gonna take the higher dividend, right? And so gematria wise, we have dividend lowers ROE over time, 137 English reduction, 33rd prime. Using leverage to pay dividend keeps return on equity ratio from getting low, 333 English reduction. Now, looking at their files a little bit, I don't believe they heavily used leverage, a loan to pay the dividend off last year because the price is really good. They really could have just paid with their net income or profits. But I think in years prior, that's what they were doing, paying the dividend with the leverage with loans and whatnot. And that just keeps investors involved. That keeps investors happy. That keeps investors company insecure. They want to see the dividend. They want to get that income. And this company makes enough money to essentially pay it. All right. As you see, they raised the dividend up. This year it's going to be 100 million. This year, 2024, they made 100 million in 2023. It's right in line. They're not. I don't think for 1 second the company is really struggling. And so, from the earnings report, I just wanted to read the highlights real quick from what Herb Jordan said. I'm gonna zoom in a little bit. This is what Herb Jordan said on the front of the ER for highlights. 90-day periods offer a short-term snapshot of a company, but it is also important to view the long-term picture. The values of our assets have seen a significant increase over the past years. The direction of NAT is unquestionably upward, with further room to grow. The first quarter of 2024 continued at a strong pace with healthy earnings. The net profit for the first quarter of 2024 came at $15.1 million, which is similar to the previous quarter, Q4 2023, with a net profit of $17.5 million. The first quarter of 2004, the dividends is 12 cents per share. This is our 107th consecutive quarterly dividend. The dividend is payable July 18, 2024 to shareholders on record as of June 28, 2024. The average time charter equivalent, TCE, for our spot vessel during the first quarter of 2024 came at 34,320 per day per ship, including vessels on term contracts. The total average NAT TCE was 33,570 per day per ship. The daily operating cost per ship was about 9,000. Going forward, we clearly see strong demand for our vessels. That's good to hear. They're paying the dividend strong. We're seeing strong demand still. The supply-demand dynamics in the market for the fleet of NAT are favorable. And that's the consensus for all CEOs across the whole industry right now. Look around, like talk to CEOs. They all are feeling the same thing. This is a great time right now. And we're just getting started. Like it's just, like it really hasn't even bubbled over yet. Like we're not even close to a top. We're still super close to the bottom. All right. The NAT fleet of versatile Suezmax tankers offer flexibility in loading and discharging ports. Through careful voyage planning and adjustment of speed of our vessels, we reduce emissions. Each individual ship in the NAT fleet is of excellent technical quality and demonstrated in the vetting performance. The scoreboard undertaken by the oil companies. So the oil companies have vetted all the Suezmaxes on NAT. They like it. They're good. And NAT has one of the number 6, the final highlight. NAT has one of the lowest debt levels among publicly traded listed tanker companies, which is good to see. All right. So this is why I chose NAT. This is why I chose Nordic American Tankers. Non-executive board of directors buying $1 million worth of shares of the company. The son of the CEO, he obviously knows something. Okay. The whole industry is favorable right now. The TCE rates, the crude oil tanker rates, they're high. All right. They're paying their dividends, 107th consecutive quarter dividend, and they are a dividend paying company. Herb Join is unquestionably saying we are a dividend paying company. We will keep paying one. And they would like to keep rising it over time if possible. Okay. And so this is why I like the company. Yes, the return on equity is important. It's still high. It's not the highest in the industry, but they have triple the dividend, all right? And they've been doing it for a long time. That's why the ROE has been degraded. Has nothing to do with the quality of the company. And so, again, I have a couple $100 in it right now. I'm going to keep adding to my position to keep growing it. And so before we end this up, let's get to the data divvy pack, the portfolio, to see how we're doing. Obviously, we're down this month, I guess. Only $30 overall for the P&L, but that's okay. Last month, we were up 131.81 in May. Now we're down negative 29.59. And mostly that came from Walgreens. Walgreens, didn't have a good earnings this last week, but I listened to the conference call, listened to Tim. I'm okay. I'm okay with it. It's a long-term turnaround for Walgreens. I actually do like what they do, and I like their I like him. I like the CEO. I like their management team, the way they talk, how their focus is. They know where the dead bodies are. This is flat out a turnaround. They're not kidding anybody. They're not kidding themselves. They're not kidding the shareholders. So right now, I'm just holding what I got. I might buy some more shares just because at these levels, it's crazy. LNC been doing really well for me, so that's a good top. And we've just been, you know, stable overall. Nothing too exciting happening on the dividend level, but that's okay. You know, we just want solid income coming in. The account right now at $4,759. The yield we have right now is 6.45%. So that's better than, you know, your highest, you know, your high yield savings accounts, which usually give you like 5%. And so I'm getting that extra 1.45% and compounded yearly overall. That adds up. And right now, monthly, yearly income is at $307.12. But if I keep buying that, the yield's going to keep going up, and this amount's going to keep going up as well. So that's what I have right now. I have 10 stocks within the portfolio right now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Actually, I like that number. I don't really see myself adding too much above 10. I'd be thinking to subtract something from the portfolio before going crazy and adding something else, and then having to re-add to the position and dilute purchasing power. And so that's where we're at with the portfolio. So right now, you asked me, well, you just added NAT, you're at 10. What would you drop from the portfolio? I still believe in BGS. I still believe in it. I think we do get a nice pump later in the year, but that one is not super long term. It still has a high yield, but I'm thinking it can move up higher and I can get some good price action growth when the time comes. So I got to be a little bit patient on that. So BGS is the primary one that I would take off once I'm in profit. And I like Verizon. I mean, Verizon's cool and all, but I might sell that at some point to take some profits off. I don't know too much about how I see it going forward growth wise. I like K-Mine EPD. They're two natural gas companies, high dividend yields. You could say that I'm over saturated in natural gas, but energy is energy, and there's a reason why I just added NAT to the portfolio, and they're both really solid companies. So and it's stable. So I think I'll keep both, but maybe at some point, if one does better than the other, I would subtract that lesser natural gas company. But other than that, I'm pretty secure and safe on what I have in the portfolio right now. And so that's the end of conference call number 16 today. Hopefully you guys learned a lot. If anybody has any questions, let me know real quick before I end this out. This is a quick, easy, simple, something that you can hang your hat on and you can enjoy your Sunday. So if nobody has any questions or anything like that, I'm gonna end it off right. All right, y'all. Love you all. Art Turner, Data Productions Media. Dreams are tangible aspirations, or we scheme our dreams to existence. I love you all. I'll see you in next month's conference call, and you guys have a good one.